So, what's eating interest rates? I'm Matty Loans. If this is your first time here, welcome. If not, welcome back. And I bet you all have seen this pic. It's from the Spider-Man cartoon of the late 1960s, turned into a popular meme, and I thought would make a great analogy for the mortgage market today and who to blame for the drop in mortgage rates over the past 5 months. The Fed met just a short time ago, and many were surprised the rates didn't go lower. So if not the Fed, who do we give the pointer finger to? The inspiration for this video comes from an article from CBS News titled, "Will Mortgage Rates Drop in October Without a Fed Meeting?" The article concludes, after various POVs from mortgage industry experts, that rates are likely to move lower, with and without the Fed. Interest rates are always a game of expectation, and although the Fed cut the benchmark rate by 50 basis points, that move alone surprised a few, as there was some debate about the size of the first cut. Those expecting to see even lower rates as a result were more than surprised that the larger cut didn't bring about mortgage rates moving lower. One of the experts in the article, Lisa Sturtevant, who's a PhD at Bright MLS, said it best, stating that everything is fine now, but stay tuned to the labor market. Further, she states that the expected Fed rate cut this week has already been baked into mortgage rates, which have been falling since July. Also, an expectation of a rate cut by the Fed in November could actually cause mortgage rates to fall in October in anticipation. Well, how does that make sense exactly? The Fed's next meeting is for the 7th of November, but the anticipation of another cut could improve rates the month before? Should that not work the other way? The Fed cuts benchmark rates and then mortgage rates go down, right? More importantly, what would cause the Fed to lower rates further if the economy's great? And why would mortgage rates move lower first? Well, turns out this is a complicated issue. Hence, Spider-Man. Because mortgage rates move for a variety of reasons, and the Fed is not at the helm of how banks lend through mortgages. Interest rates fluctuate for a variety of factors: the environment, the supply and demand of money. Now, the government plays a role in this, but doesn't mean they make the market. When the economy is expanding, expect a higher demand for money, which banks will then set higher rates for their loans, mortgages included. But when the demand is low, expect interest rates to fall. Interest rates represent the cost of borrowing money. Like any other commodity, the price of it is impacted by the supply and the demand. Right now, the economy is fairly healthy. As Lisa Sturtevant says, the economy is moving along, and by historical standards, unemployment is very low. When this turns, it's fair to expect the banks to put their loans on sale. When the economy slows, there's less job creation. There'll be less people buying homes, cars, spending money in general. Banks can respond by dropping rates. Now, banks aren't going to do this on their own. It's going to take some help from some other Spider-Man derivatives, if you will. Here are 5 important factors in the what's eating mortgage rates. First, take a look outside. What do they say? Dress for the weather? Well, how is the economy? Is it booming or is it kabooming? Interest rates rise with an expanding economy and contract with a recession. A recession is a sign of a weak consumer because consumers will spend less. Companies and investors will do the same. Take a step back, reduce the budget, delay a project if times are tougher. This may include periods of deleveraging or taking out less credit with an uncertain environment. Under that umbrella, expect market conditions to bleed into the housing market. When fewer homes are built or for sale, this reduces the expansion of credit and will push rates down. Or this can happen when consumers opt to rent instead of buy. This will impact home inventory and can impact rates. To track the housing market specifically, I recommend looking at the Case-Shiller Home Price Index and the months of supply and inventory, 2 data points which are released monthly. These are great indicators if it's a buyer's or seller's market, and if prices are increasing, stable, or declining. Next, old man Fed. The Fed oversees the financial system and defends it through the dual mandate: max employment and price stability. That's it. There's only 2 of them. They're not concerned with the housing market, and the Fed commented recently that the housing stock is a long-term problem, something the Fed can't fix, and that interest rates can't fix alone. Old man Fed has a few tricks up his sleeve to aid the markets, one of which is short-term monetary policy. It's clear to see that the Fed has changed its stance from hold to fold. When the Fed reduces rates for the first time in September, it does influence interest rates in general, but it doesn't specifically turn the dial on mortgage rates. Now, a space where it will directly help home finance is through a home equity loan or line of credit, as most of those rates are based on the prime rate. Prime is 300 basis points over Fed funds, which is now at 8%, down 50 basis points directly from the Fed cut. In most cases, equity lines are the prime rate plus a margin. So figure that money is still at 8-9%. In case you didn't know, the government does purchase most mortgages for banks that are less than $766,000. Through monetary policy and in times of a crisis, the Fed can buy government debt, which will pump liquidity into the market, which can be used for new loans. An increased supply of money paired with a decreased demand for credit can force rates down. When the economy expects the Fed to withdraw liquidity as the demand for credit is high, interest rates will follow higher. The Fed meets 8 times per year. This is a highlight for markets and a good indicator on how the Fed is calling the match. A rising rate environment is all about economic growth. I like how the article references several opinions on how mortgage rates are shaped, but one they didn't include was GDP, or gross domestic product. Not that it's a main ingredient for the mortgage market, but you need to tune into it to see if the economy is still expanding. With economic growth comes jobs, higher wages, more spending, in particular, consumers seeking homes and loans to finance the purchase. These things we all ultimately need and want, but the downside is, with the greater demand for homes and home loans, this will increase the likelihood for banks to charge more for their money. So GDP is a sign of the self-fulfilling prophecy. As the economy expands, good things are happening, but at the cost of more expensive money. If the market supports higher rates, then great. But if GDP shows that growth is sluggish, how do we expect companies to respond? Job cuts, reduced wages, which in turn reduces the need for a larger home purchase, less lending, and so on. Since the 1950s, it's averaged about 3%, which gives you a baseline read if the economy is expanding or contracting. GDP reports on a quarterly basis. You know what they say, it's all about diversification, and that includes your bonds. Banks will offer mortgage-backed securities as investment products. The yields can provide income to investors if the price is right. The bond market's all about risk and reward, and mortgage backs compete with government and corporate bonds. The condition of the bond market will influence how lenders price their mortgages. The biggest yardstick for the market is the 10-year Treasury. The 10-year note represents the government bonds, so the spread between mortgages and the 10-year needs to be convincing enough to take the MBS, because government debt is guaranteed. The MBS market isn't, and that could make it more or less attractive depending on the price. You can look at the 10-year note on any economic news site. Just type in TNX, and it's a great indicator for interest rate trends, mortgages included. Likely the biggest driver of the rise and fall of interest rates is inflation. Inflation measures the change in prices for goods and services. We monitor inflation through reports like CPI and PCE. As the buying power per unit of currency drops, the purchasing power falls, and it'll take more units to purchase the same goods as in the past. Inflation refers to the rise in prices for goods and services. As such, the buying power of one unit of currency drops, which means it erodes the purchasing power of dollars over time. Looking at the CPI index over time is an important factor for banks, as they have to maintain interest rates at a level that is enough to overcome the loss of purchasing power to make sure their loans return a profit. Mortgage rates today are around 6%, with the core inflation reading about 3%, hopefully providing enough spread to make the deal profitable, something that was very hard for banks to do over the past 2 years. How deep a lender goes into the spread is controlled by risk appetite. Due to the volume of money lent during the pandemic, many lenders today are in a tough spot when inflation increased rapidly, making these loans lose a tremendous value in a short period of time. It appears inflation has peaked in the summer of 2022, but we'll have to see if this continues to decline further and how banks will react. We've seen a turn of foot from the Fed from the September meeting with the rate cut and what they call the balance of risks, focusing less on inflation, more on the labor market, something the Fed does not want to see further weakness from. In efforts to curb inflation, the Fed raised rates the fastest pace in 40 years, coming from basically 0 to 5.5% in 16 months. Remember, the Fed does not set mortgage rates, but does raise and lower the overall cost of borrowing, and somewhat impacts consumer choices between saving and spending money. Inflation can be tracked with monthly reports from the CPI, PPI, and PCE. These are great indicators to follow when watching mortgage rates. As inflation falls, it'll force lenders to reduce their rates to stay competitive and generate new business. Expect all of these influencers to shape interest rates moving forward. We know what to expect from the old man as, quote, the Fed has changed their sentiment to one of reducing the borrowing rate. Deepak Nura says in the article, the markets now understand that the Fed has no choice but to lower rates. Investors and banks will act accordingly. But don't expect rates to just continue to drop because all of these inputs are important in how banks manage risks and attract new customers. We all may agree that the trend from here may be lower, but it won't be without its pauses, rises, and drops further. Mortgage rates change daily and rapidly. So look at the economic calendar ahead to help you with your decision. I'm Maddie, and that's all I got to say about this one. See you next time.